thanks very much, everyone, for coming to this. My name is Mark Masson, Director and Partner with FD Recruit and Exec Recruit Group. Big welcome. It'll be fairly informative and relaxed and hopefully enjoyable. Many thanks to Nick for giving his time and this presentation. And Nick is much better at introducing himself and everything he does than me, but he is a well-known deal advisory partner in that world with Gerald Edelman. Nick, if you want to kick off for your presentation, and then we'll get through some of the questions that people put in the chat box afterwards. So thanks very much.
Perfect. Thank you, Mark. And really good to meet everybody. Just before I start the presentation, I thought it might be helpful just to give a brief background to me and who I am and what I do. So Nick Wallis, as Mark said, I am a partner at a firm called Gerald Edelman. We're a mid-market accountancy professional services firm based in London, top 50 accountancy firm, and I head up our M&A team, our deal advisory team. I actually started my career at Lehman Brothers, but the less said about that, the better, probably. Then moved quickly into accountancy, where I qualified at one of the big four accountancy firms as an accountant. So I am a chartered accountant for my sins as well. And I spent about 8 years at PwC, it was, where I quickly, as soon as I qualified in audit, moved across into the deals business. So working on sort of fairly large transactions, both from a due diligence perspective and from an advisory perspective. I then spent just over 3 years at a boutique corporate finance firm, decided that working with entrepreneurial, owner-managed SME businesses was more interesting for myself. Meeting entrepreneurs, understanding how businesses ticked. So I spent 3 years as a director at a boutique corporate finance organization. And then I joined GE, Gerald Edelman, about 4.5 years ago to head up our M&A team here. And when I joined, we were quite new in terms of M&A. The firm's been around for about 90 years, where our M&A department was fairly new. And we had about 3 or 4 people. We're now up to 20. So we've had pretty good growth in the last 3 or 4 years, largely driven by market dynamics. And also we've had a real push internally to grow our offering. We work with owner-managed businesses largely, who are looking to either exit their business or to raise some capital for growth, or a hybrid of the two. And that does happen. The scenarios or situations are very similar for both of those things. We work with businesses with a value of anything from sort of 2 to 100 million is our sweet spot. So what we call the lower mid-market, and across all different sectors as well. So that's my focus. That's what I've been doing for the last sort of 8 or 9 years of my career, but obviously been doing M&A for a lot longer. I think the purpose of this presentation is to give a bit more background into the M&A process itself, why planning and preparation is important, some key things that business owners, FDs should be thinking about now, even if the exit isn't on the horizon in the immediate future, thinking about business valuation, how much is the business worth, and then thinking about life after sale as well. I'm going to run through stuff fairly quickly, so in about sort of 15 minutes or so. And I do speak very fast. So if anyone does have any questions or I miss anything, please just pop them in the chat box, and we'll go through afterwards. Very happy to answer any questions either in this forum here, or in a separate forum as well. So that's kind of a bit of background to me. I'm just going to share my screen. Hopefully the technology will work so that everybody can see a brief presentation that I've pulled together. Can everybody see that?
Yep.
Yeah. See, good. Perfect. So this is kind of aimed at people that are thinking about selling a business, whether that's a business owner or kind of as someone in sort of the senior finance function. So there's some different hats here that this is aimed at. So it's probably not going to be completely relevant for everybody, all of it, but hopefully it'll give you a good flavour. In terms of, let's just make sure that works. In terms of the content, I think we just touched on all of those things. So let's move forward. So let's start with planning. So planning for an exit is critical, in my opinion, from my experience. And it's never too early to start that planning process, I think, is one key takeaway from this. Even if it's 5 years, 10 years, even 20 years away from an exit, it's never too early to start planning, because there are things you can do now. We say to people at least 6 to 12 months in advance of an exit to start the formal planning process, ideally a couple of years. But really, it's kind of at least sort of that 6-month period before an exit. And we talk about maximizing value for the business, but from my perspective, it's also about maximizing and increasing saleability. I think that's really important as well. To increase the chance of having a successful completed transaction, I think is really important. So from this perspective, it's about value, but also about saleability. It gives you the time to prepare and identify and sort potential issues in the business that make sure that the business is ready for a due diligence exercise. Now, for those of you who don't know, anytime a buyer comes to buy a business, they will do very extensive due diligence. And that due diligence is becoming more and more and more intense. In a COVID world, in a Brexit world, every investment decision is being scrutinized more and more. So the due diligence that we see today is, in some cases, double what it was 3 or 4 years ago. And so what we want to do is we want to minimize the risk of a deal falling over, or the investor or buyer changing the terms of the deal because of issues that they find. So if you were looking to buy, and there's a lot of similarities between buying a business and buying a house, there's also some very key differences as well. But if you were buying a house and you were looking around the house and you noticed just that there was a dripping tap from the shower, or the tap in the bathroom just was leaking or didn't quite work, they may be the only 2 completely minor issues in the business. But as you're someone that's buying that house, you naturally think, well, what else is wrong here? You naturally have that, and you think, how much is it going to cost me to fix these issues? And it's very similar when you're buying a business. You want to make sure, as a seller, that you've got a completely clean bill of health. So it reduces the risk of a deal falling over or a big price chip. So by having time to prepare and sort any potential issues in advance, we think is of critical importance. The other thing is that one of the other things is that one of the biggest reasons why deals don't happen when business owners in particular think that they have a very attractive business is the business owner themselves, or key people in that business themselves, whereby the business is very reliant on 1 or 2 key people, being normally the owner managers themselves. So people often come to me and say, right, I'm ready to sell my business. And I say, okay, well, what's your role in the business? And they say, well, I do sales, I do marketing, I run the business, I do finance, I do everything. And I say, okay, what's your plan going forwards? Oh, well, I want to leave on day 1. Now, in reality, that just doesn't happen. That's just not going to work, because who's going to buy a business where the key value in the business disappears on day 1? So the more time you have in advance of the exit, the easier it is to put in place a succession plan. And creating that exit strategy means you can focus on that succession plan. Now, it doesn't mean that that business owner or the finance person or whatever has to be out of the business before we go to an exit at all. It doesn't mean that at all, but it means that at least we can put the plans and get the ball rolling on that, and we can start to get that. So when we talk to potential buyers, we can say, yes, I do these 3 key things in the business, but actually we have a plan in place for me to step out of the business over the next 2 to 3 years, regardless of a potential sale anyway. So at least the buyer knows that there's that succession plan in place. The next thing is kind of planning can assist in identifying what we call trigger points for when personally the key people in the business want to exit. So I think it's really important to think, what does the business owner or the founder or the key people in the business, what do they want? And then work backwards from there. So let's kind of put a plan in place based on what the expected output is. And I'll talk a little bit more about that in a minute when I talk about objectives. The next key thing I think planning is important for is protecting assets. So anticipating any issues in advance in regards to key contracts, in regards to key staff, in regards to anything like that that's kind of key for the business, making sure we can put proper protection in place, whether that's a share option plan for key members of management, or making sure that we tie and give big customers up to long-term contracts, or whatever it is. I think putting those things in place now, whereas before you may not have had to think about them or worry about them. I think, you know, doing those things in advance of an exit is really important. Also giving you, you know, the longer you have, the less time pressured the bulk of the planning is. So what I mean by that is, you know, being ready for the process. The process is intense. It's very intense. I'm not going to lie and sit here and tell you it's a walk in the park. It's intense. So having done the bulk of the work in a non-time pressured environment will really help the process down the line. So it means that people aren't giving up their day jobs in a sudden panic to prepare documentation in 3 weeks. And then that links into the final point here, which is around momentum. So momentum in any process of selling a business or raising funding is really important. And we want to make sure we're keeping momentum. So if someone a buyer asks for information and you're scrambling around, taking 2-3 weeks trying to provide that information because you haven't got your ducks in a row, first of all, it doesn't look great to the buyer, but second of all, you lose momentum. The buyer's moved on to other opportunities and then you lose that potential. But if you've got a data room already there and you've already done the planning and you've already got everything, you can open it up. You keep momentum and everything can move fairly smoothly and fairly quickly. So that's kind of what the key thing around planning. And as I said before, it's never too early to start planning in our view. But here are some of the key things, and I've touched on some of these already, the key things that we think key senior people in the business owners, key senior people should be thinking about now. So as I said before, preparing for due diligence so that we know that there are no skeletons in the closet. Anything that there is a skeleton, we can tidy up before we start talking to buyers, or at least we can have a planned resolution. So for example, if there's a dispute with an employee, or there might be an outstanding litigation, or there might be an issue with your GDPR policies or something like that, you know about it. Let's try and get a solution. I'll get a lawyer in today to review your GDPR policies. So the lawyer says, I've done a review, everything's fine. At least we can then go to the buyer and say, look, we knew there was an issue, but the lawyer's now reviewed it and we've changed the policy and the lawyer's given us this opinion. It just helps with that credibility point. So our advice is doing a due diligence review, not doing due diligence, but a review sooner rather than later is of incredible value to try and ensure there's no skeletons in the closet. As I said before, succession planning is important. What is the plan post-deal? Let's make sure that we can put some of those plans into action today. The next one I think is also really important, which is more around the revenue and the financial planning and strategic planning. Pretty much everyone that sells a business is going to present a growth plan saying my business is going to grow over the next 5 years and we're going to show a hockey stick of growth over the next 5 years. The idea behind that, and we'll talk about valuation shortly, but the idea behind that is that we want buyers to pay for the business based on what the business is going to do in the future, because they see a growing business and they believe in it. Now, the only way they're going to believe in it is if that growth is credible. So, for example, if you said we're a UK business and we're going to grow overseas, we're going to open offices in Ireland and in Portugal and in Spain. That's our growth plan. If a buyer's looking at your business and you've only ever done things out in the UK, they're going to look at you and go, well, hold on a second, there isn't really much credibility to that plan because it's just an idea. If you already have 2 or 3 people on the ground in Ireland, 2 or 3 people on the ground in Spain, it might be early stages, but you've opened an office and it's small scale and you've started generating revenue there. It just gives you that credibility that you're on track to do that, even if it's at a small scale. So those are some of the things that can take a bit of time to implement in advance, and which is another reason why planning in as far in advance as possible is important. So those are the things that can maximize value, and the buyer will pay for that because they can see credible growth. Data room preparation is really important for a full process, or often what happens is someone actually approaches you directly and says, can I see the books? And if you've already got a data room and you're regularly updating it, again, momentum is going to be really, really helpful for the process. And then the final thing I think people should be thinking about now is objective setting. What is your magic wand scenario? And we'll talk a little bit more about that now. And when I say magic wand scenario, I'm thinking about these 8 things. And there's probably lots of other things, but these are the key things from my perspective. What's the number? what would be the value that you would want to receive in consideration today to be able to sell the business? Timing, what's your timing? Is it, you want to be out in before you're 50 or before you're 70 or before you're 40 or whatever it is? Or is it actually, we've got family circumstances, I need to be out in 6 months? Or is it actually, I'm a bit more relaxed about it and I'm happy to stay involved for the next 8 to 10 years, but if something happens, then great. What is the ideal timing for this? Because that obviously links into how much planning we need to do and when do we start approaching the market. What's your preference? Is it a financial investor, someone that's going to come in, potentially give you some cash, give you some money off the table, but keep some skin in the game and have a 3 to 5 year plan to a full exit? Or is it a strategic buyer who's going to come in and buy the whole business today? What about your management team? If the management team is different to the owners, what do you want for them? Is the objective for the management team to do a management buyout? Is the objective for the management team that they get looked after? Do you actually not care about your management team? And if a buyer comes along and says, actually, I'll buy the business, but I want to get rid of the management team, is that acceptable to you? So these are the things to think about now. Reputation and risk of a buyer. There are certain buyers out there, I'm not going to mention any names, but there are certain buyers out there that don't necessarily have the best reputation. And therefore, if someone gave you the right amount of cash, would that matter to you that your business is going to a home that doesn't necessarily have the best reputation? And for some people that will be yes, and for some people that will be no. But these are the things to think about. Ongoing roles for shareholders and management team. What's your preference? Are you planning to stay involved in the business going forwards? We see scenarios where shareholders say to me, Nick, I want to exit on day one. I don't want to be involved in this. And then the buyer says, look, we want you to, be involved for at least a couple of years going forwards. And then 6 months down the line after the transaction, they go, oh my God, this is fantastic. I love it because suddenly I don't have the pressure of owning the business anymore. I'm still running the business. Everything's the same, but it's not, I don't have those cash flow pressures. I don't have those day-to-day decision-making pressures. Everything's on the line. I've de-risked. I've got the money in the bank. Everything's great. And I have some business owners who think that they're happy to stay and actually realize that they can't work for other people. And absolutely hate it going forward. So take this one with a pinch of salt, but we're talking about magic wand scenario here. What's the preference? Do you have family involved in the business or friends involved in the business? What would be their ideal involvement going forwards? We've got one at the moment where brother and sister own the business, a CEO and a CFO, and their mum is a 5% shareholder, and she takes out a salary every month from the business. She's not involved actively in the business, but the buyer's looking at it and saying, well, obviously that's going to stop. Well, how does that impact mum's lifestyle? Well, we have to give her some of the proceeds of our proceeds from the transaction. Things like that are just things to think about now. And the other thing is forms of consideration. Obviously, everybody wants as much cash as possible, but are you comfortable with a bit more deferred cash? So cash that's effectively payable, potentially payable in the future based on hitting performance targets, or non-cash? Are you happy to have shares in the buyer? And obviously that depends on who the buyer is. But things like that are just things to think about now in terms of objectives. So these are things that as a business owner or as a key management person in the business to be thinking about today. As I say, if you've got any questions, please put them in the chat box. But I'm just going to move on quickly to talk about valuation. So thinking about how much your business is worth. Now, ultimately, as I said at the bottom there, a business is worth what someone is willing to pay for it. So there's lots of different valuation metrics and multiples and all sorts of things and calculations that you can do. But the business is worth what someone's willing to pay for it. So we often get asked by companies, can you do a valuation report for us? Can you do a valuation report to see how much my business is worth? And the answer is, of course we can, but I don't see much value in it. Unless there's a specific situation when you need it. For example, there's a dispute or a divorce or something like that, and we need to specifically value the business. If it's just a case of working out how much my business is worth, going through a formal valuation process is not really worth it. You're only going to really understand the value of the business by going to market and talking to potential buyers. However, it is helpful for business owners and FDs to think about how much the business is worth and how to increase the value of the business. So these are the key. There's 3 key methods here. So we've got discounted cash flow. This is where we take the projected cash flows of the business over the next X years and discount them back to today's value, and that effectively is the value of the business. Now, the issue with that is, for most businesses, having predictable cash flows is an issue. I've never met a business that everyone knows what their cash flows are going to be in the next 5 years. The bigger the business, the probably easier it is to predict, but especially for an SME, it's very unlikely you can predict cash flows. Also, what cost of capital do you use to discount? I'm not a massive fan of discounted cash flows, and I think it's very rare that we see SME businesses being valued based on DCF, discounted cash flow models. Personally, people may disagree with that. Moving on to the third one, which is an asset-based valuation. This tends to be used for very asset-heavy businesses. Kind of what is the value of your net assets or the value of your assets on your balance sheet? And that's the value I'm going to pay as a buyer. Again, for asset-heavy businesses, we do see it, but quite rare in our world. The vast majority of SME businesses are valued on a multiple of profits. And that's based on looking at comparable companies and comparable transactions and doing analysis around those things. So what have other transactions, what multiples have other transactions transacted at in the last X years for similar businesses in similar sectors? And that's the real way we value a business. But obviously there we've used, the majority are based on a multiple of profits. There's two key numbers there. What multiple do we use? What profit number do we use? Now, that multiple depends on a whole load of things. The sector is a key one, and size is another key one, and there are some other factors as well, which I'll talk about in a minute. Sector, technology businesses tend to be higher multiples. Actually, sometimes you get multiples of revenue for technology businesses, particularly where they're software businesses with recurring revenue. There are some businesses where the range of multiples is very high. And there are some businesses, recruitment businesses, sorry, Mark, our business, for example, where there are very narrow ranges of multiples. Construction businesses as well is another example of that, where there are very narrow ranges. It's a very set criteria of what it is. So that's kind of multiples. Multiples can range. To give you a rule of thumb, the vast majority of transactions that we see for SME businesses transact between 4 and 6 times profit. But there are plenty that transact less than that, and there are plenty that transact more than that. But that's just kind of a rule of thumb. But then again, what profit number do you use? Do you use last year's profit, an average for the last 3 years, the current year, next year, 5 years' time? Now, obviously, as a business owner or a seller, the higher the number, the better. And that's obviously the ideal scenario. But in reality, the most common method is the current year of profit. And what we would do is we want to normalize that profit to make sure it's reflective of an ongoing business. So if you're the current shareholder or current business owner or management team, and you take costs out of the business that wouldn't be reflective of the business going forwards, that's the profit number that you want to present to a buyer, because that's what we call a normalized level of profit to apply a multiple to. In an ideal world, we want a multiple of profit in 3 years' time, because that's going to, especially we've got to get growth. But coming back to what I said before, the only way a buyer is going to do that is if they can believe that growth, it's credible, or it's secured already. And that's really important. But as I said before, ultimately, a business is worth what someone's willing to pay for it. I sold a food safety standards business a few years ago called BRC Global Standards. And when we met the owners of that business, based on all the other transactions and comparable companies that we've looked at, we thought probably 6 to 7 times profit, which would equate to, it was about 2 million of profit. So we'll equate to 12 to 14 million pound of profit was our estimate of value. The buyer ended up paying close to 40 million, 40. Now, obviously, that's a fantastic result for our client. But the reason for that wasn't because well, first of all, it's a competitive process. But in reality, the reason they paid so much is because the buyer had the infrastructure already in place to plug in the existing company into that infrastructure, particularly overseas in places like the US, India, and China. So once that business had been plugged into those overseas territories, it could grow from 2 million to 10 million of profit within 18 months, 24 months, which is actually what it did. So in the end, actually, the buyer thinks they've underpaid, but everyone else is happy. So there are situations there where you could do a lot of comparable company and transaction analysis, but in reality, the business is worth what someone's willing to pay for it. And how do we increase that multiple? And what does, or because of what an acquirer attributes value to? As I said, this, and a lot of these things are kind of what I was just talking about there, particularly around the synergies, in the business, and that BRC example I just talked about. But a strong incentivized management team is important, especially if they're going to be running the business going forwards. Credible growth opportunities, as I've said a number of times already. Contracted work or visibility of income, recurring income is important. Sustainable profits. If you've got a very lumpy business like this, well, it's very difficult for a buyer to work out what the maintainable level of profits is. If you've got sustainable growing profits and high margins, that really helps. Strong barriers to entry. It means that they can't go and do it themselves. They can't spend the same amount of money going to do it themselves. Synergies, as I talked about. Low fixed costs, so operational gearing. A diverse supply base. A strong asset base. Obviously, a strategic and competitive tension in our process, people bidding against each other is helpful. And there's loads of other things there. So as I said before, if a buyer's got the infrastructure to drop a client's existing business into their infrastructure to enable it to grow, rather than having to spend the cash to do it, that adds a lot of value here. The other thing is timing. We sold a business last year, which was a direct-to-consumer computer manufacturing, gaming computer manufacturing business, where the buyer sort of said, look, we know that the average multiple of this business is probably 6 or 7 times, but we're happy to pay 10 times because we want to get it done and we want to get it done quickly. And there's a timing thing there, an opportunistic timing piece. I realize I'm rambling on quite a lot, so I'll skip through this quite quickly. But in terms of the M&A process itself, apologies for those of you who've been through a process or know the process. But there's kind of split into two here, as seen by the line. So the first piece is planning and preparation, which is all the stuff I've just talked about here. So it's setting objectives, it's doing the due diligence review, it's going through and preparing a data room, it's pulling together a financial model and growth plan, it's pulling together sales documentation, it's identifying who might buy the business. That can be anything from 1 month to 2 years, even up to 5 years to do that strategically. As I said before, never too early. Once that's happened, it's then about going out and approaching potential buyers, meeting them, management presentations, information sharing, inviting offers from people, negotiating those offers, tactically using heads of terms to include as much detail as possible while we've still got bargaining power in terms of the competitive position, granting exclusivity as part of that to enable a buyer to go and do their due diligence. And then it's a case of that due diligence piece as well, all the way, legal documents all the way through to completion. So that's a typical M&A process. Obviously, every process is different. That 4 to 6 month period there was 3 to 5 months. It's now probably more like 5 to 7 months, 8 months. Everything just seems to be taking a lot longer, in the last few years. But 4 to 6 months is what we aim for. In terms of the finance team, or the FDs, what is expected of you? So being involved in that due diligence review, naturally. You'll have eyes over the majority of the business. Provision of financial and non-financial information to be used as part of the data room and in preparation of a financial model and IM, which is the sales document I just talked about. Being involved in management presentations, meeting potential buyers and investors and getting to know them. Q&A back and forth through the negotiations. So there's going to be always various Q&A. And there might be vendor due diligence as well, which is something I haven't talked about, but let's assume there's no vendor due diligence for now, although happy to take any questions on that. Assisting with the due diligence process, that's the bulk of the time here. That's a right pain. And as I said before, it's becoming more and more intense. And there's going to be various Q&A back and forth. So the finance team is going to be integral to that process, particularly around the financial and tax due diligence, but also probably around the legal due diligence as well, which is going to be around employment and contracts and insurance, etc., etc. There's going to be a process around warranties. A business owner selling a business will have to give warranties about that business. Again, happy to answer any questions about that. But again, there'll be disclosure against those warranties, making sure that everything is completely accurate in those warranties. And there may be a case of preparing some accounts after the transaction, but as at the completion date, to account for cash, debt, working capital, and all those sorts of things. Again, I could do another hour session just around that. But again, preparing completion accounts will be part of the role. And then finally, while I stop rambling on, in terms of thinking about life after the sale, as I said before, thinking about that now is important. what does life look like after the sale? Do you, as the key management and the owners of the business, want to remain involved in the running of the business going forwards? And I think that's really important. But also, there's potentially a significant pot of cash here for people that have shares in the business or bonuses as part of a transaction. So thinking about lifestyle planning and financial planning, what's your financial planning strategy? There are plenty of things that can be done now. Even if it's not for 1, 2, 3, 4, even 5, 10 years, there are things that can be done now on a personal level, let alone a business level, to increase personal wealth. Thinking about financial planning in terms of your investment strategy for your proceeds, thinking about estate and inheritance tax planning, really important. Thinking about your own retirement planning. What is your number? What's your magic number that you need to go and be able to retire and do the things you want to do in retirement without having to worry about work? Have you thought about that? People talk about the number for the business, but don't actually think about the number for themselves. And I think that's a really important exercise for people to think about. That number might be less than you think, in which case you may not need to wait 5 years to sell your business, and actually you might be able to do it in the next 1 to 2 years. The other thing to think about is tax. Right now, there's a very advantageous tax rate in entrepreneurs relief or business asset disposal relief, which is 10% for the first £1 million of proceeds per person, assuming you've held the shares for 2 years. After that 10% is 20%. There's still advantageous tax compared to higher rate dividend and higher rate income tax. Now, there are rumours that if a Labour government were to come in 18 months, that those advantageous tax rates might disappear. So if people are thinking about selling a business now, is it worth accelerating that to benefit from those beneficial taxes? So lots of things to think about. But also, if you want to benefit from those taxes, there are things you may not be eligible based on the current structure. If you're not an employee or a director of the business, you need to be to make sure you benefit from those, and you need to do that for 2 years. So if 2 years is your plan, there are things you can do now to make sure you benefit from those taxes as well. So I appreciate that was a sort of whistle-stop tour of kind of the key things around planning and preparing, and obviously the exit process and valuation, all in the space of about 20 minutes. And I appreciate I've rambled on, but obviously very happy to answer any questions as we go through. I'll stop.
Nick, that was brilliant. I certainly didn't want to, cut you off there. That was really comprehensive. So yeah, just moving swiftly to the sort of floor. We've got a few questions. I see Stuart's asked a couple, Colin's asked a couple, and a few others. So I mean, Stuart, if you want to stick your hand up and ask your question on EBITDA, and also your question on cost of getting a company ready. If you want to just ask Nick those couple, and then in a couple of minutes we'll move on to some of the other questions.
Sure. Really easy ones. I'm used to valuing businesses based on EBITDA, and you said profit. So which is it, and what's your view? Yeah. And the second question. Oh, sorry. Yeah, go on.
Sorry, let me answer that one first. Yes, EBITDA, we would normally see EBITDA. There are some businesses, if it's a particularly asset-heavy business, we might use EBIT rather than EBITDA. And our profits are generalization of all of those things. But okay. Yeah, a multiple of profits. I'm normally talking about EBITDA, and it's a maintainable or sustainable EBITDA. Because the reason why is it's most representative of cash.
Cool. Okay.
Yeah.
One thing I've had with talking to business owners is, you've got to make an investment in selling the business. So what is your experience what do you tell a general business owner as to how much money they should spend to get the business ready for sale? I'm talking lawyer costs, new contracts for key management staff, GDPR reviews, data room, just, what money should they set aside to send out the door?
It's a very difficult question to answer because it depends on the business, and every business is different. Some businesses will have done a lot of it already, in which case the cost can be pretty minimal. For those that haven't and need to sort of start from scratch, I still don't think it's particularly excessive. A lot of lawyers, and I don't know if there's any lawyers on the call here, but a lot of lawyers will do a lot of that work, not so pro bono, but at reduced cost if they can get the bigger M&A mandate down the line. So I think, it's probably to do a due diligence review, like prepare a data room, financial model, a review of GDPR, review of employment contracts, all that sort of stuff. It doesn't necessarily need to be more than probably somewhere between 15 and 30 grand, I would think. I don't think it necessarily needs to be much more than that. It can be more. Don't quote me on that, because obviously if you then need to implement a new GDPR policy and then issue another 20 employment contracts, obviously there's going to be work on top of that. Or if you need to get the BRC business I mentioned, that there was a big issue with the trademarks, and they needed to get IP lawyers involved, and there was a 3-4 month project to do that, in which case obviously that's a separate cost associated with that if something does need fixing. But to do the review itself, it doesn't necessarily need to be more than that, I wouldn't have thought.
Okay, great.
It can be done pretty cheaply.
Thank you.
All right, is that okay, Stuart?
Yeah.
And obviously everyone benefits from hearing some of those answers. Colin, you've asked a couple of questions on comparable multiples and B Corp. Do you want to fire away on those?
Yeah, sure. Yeah. So, I mean, the first question is a slightly philosophical question, but obviously, I've seen in the past the use of comparable multiples, and I guess what kind of prevents deals being constrained by kind of the historic perspective? Because if everybody's looking backwards and looking at kind of historic deals and historic multiples, how do we break out of that kind of range if that's appropriate for our business?
Yeah, and that comes back to, I don't like multiples, because when you look at multiples, not everyone quotes them on the same basis. So someone might say, oh, well, yeah, we got 25 times multiple for our business, but they did, but it was 25 times what the profit was 5 years ago. If you look at the profit this year, it was actually only 5 times. So, and the buyer hasn't paid 25 times, they've paid 5 times. So multiples, I'd always take multiples with a pinch of salt. They're very helpful, in my view, to get a guideline of what the value should be. But you're never gonna, every buyer is going to have a different way of valuing a business. And for example, we're doing our own M&A at the moment, and we don't use a multiple of profits, and we don't use a multiple of revenues. We've got a very distinctive model that we use that links to payback and sorts. So everyone's got a different view of multiples. I take your point. There are only, how far do you go back? Because multiples have been using multiples, and you could do a 20-year average of the last multiples. Obviously in COVID times as well, many businesses went through that period where they had 6 months of no trading, or they had 6 months of bumper trading, or vice versa. So it's a very difficult question to answer on the basis that every business is different, every sector is different. But I think what multiples are useful for is to give a guide of value. For example, if you're a recruitment business, we know that recruitment business transact at somewhere between 3 and 6 times. That's kind of a good guide for a recruitment business. That's kind of it. How do you get from 3 to 6? Well, that's a separate conversation. So that's kind of helpful from multiple perspective. But in terms of an individual business, every buyer is going to value it on their own merits.
Yeah, and I guess competitive tension is a key one as well, isn't it, in terms of being able to get to the top end?
There's the balance between getting a deal done quickly and competitive tension. And I often see buyers or companies come to me and say, we've been approached by a potential buyer. Can we just run this process? Can you go and speak to them? And I always say, yeah, of course I can. And the momentum, as I said before, is really important. But is it worth speaking to 2 or 3 others just to get a bit of competitive tension there? You're still not going to get as much competitive tension as if you're talking to 20 or 25 buyers, or even more. But just by getting 1 or 2 others in the mix, you tend to be able to leverage the price and push it up a bit. So yes, I completely agree with that logic.
And then my second question very quickly was just to what extent is B Corp status a relevant factor within the SME market?
Right now, not yet is the answer. It's not really, but I think it will become very important. ESG generally is becoming more and more and more of a hot topic for people. And we're starting to see in due diligence questionnaires, questions around how you, not necessarily how you comply with B Corp, but how, what ESG credentials do you have and that sort of thing. So it's starting to come up, and I have no doubt that it's going to get bigger and bigger over the next 5 to 10 years for sure. So the answer is not yet. I don't think it's going to be one of those things that gives you materially extra value, but it's going to be one of those things that means that you're chosen ahead of another potential acquisition target, if that makes sense.
Yeah, thank you.
That's my view anyway.
Thanks a lot, Colin. All good with you? Okay, and I I know Laziza, I don't know if Laziza's still here, but I think she asked a question that possibly is being covered. But what about non-financial factors that impact valuation, such as ESG, which you just sort of talked about? But
yeah,
I don't know
as I
if
said,
there's anything else you want to add.
I don't think ESG itself is going to probably drive the value, but it's going to drive the saleability piece. I think it probably will drive value, but I don't think it's a massive factor for some business, so some buyers right now. It will be for some, but for most, it's probably not yet. But I think it will be.
Sorry, James. You've asked a question on approach, change, etc. Yeah, fire away.
Yeah, on private equity. So how does the approach change when the main buyers are private equity? I can think of quite a few differences. Obviously, they may not be synergies unless it's a buy and build strategy. There will be more focus on due diligence, probably more aimed at chipping the price. There may be more focus on the management's package. And bear in mind, they make their money from doing the best deal both in and out.
Yeah.
Bear in mind also probably certain sectors more vulnerable to private equity than others. Would love to hear your views.
Yeah, I think you've covered the key points there. I think the process itself is very, very similar. If you're running a formal private equity process, you probably will do some vendor due diligence to start with. That might be the one key thing difference in terms of that overall process piece. As you said, they're not going to apply, the idea of private equity is they want to buy as cheap as possible and sell as high as possible. But I think it depends on who the private equity firm is. We see a lot of people that pay very fair prices, fair multiples. They're not going to pay the strategic synergy value that, in my BRC Global Standards example, the buyer actually was a private equity backed company, but it was a strategic trade buyer. Were bidding against some private equity firms, and the private equity firms just couldn't get to that 18 times multiple. They just couldn't. They couldn't justify it. Whereas obviously in that case, the buyer could, because they had the strategic synergy value there. So that's probably one of the key differences. But then again, we see situations where private equity are the highest bidders. The key thing for private equity is management team. Absolutely number one on their list. You can have the best business in the world, but if you don't have a good management team, private equity won't be interested. So that's why they insist on meeting the management team before any offers are made or anything like that, because that's a key thing for them. As you said before, their due diligence focus might be different. They're going to do more commercial due diligence because they're probably not going to understand the market dynamics nearly as much as the buyer, as a trade buyer. Interestingly, we were working for a trade buyer a couple of years ago in a telecoms business, and the seller had been running a private equity process, and they'd done some commercial due diligence, and our client was a buyer, a trade buyer already in the sector, and he looked at the commercial due diligence and he went, "This is a load of rubbish. Like I could have written a better report than this, and they probably spent £100,000 on it." So take some of that with a pinch of salt. But from a private equity perspective, they don't know the sector, so there's going to be commercial due diligence, as you say. They're going to focus on the management team a lot more than a strategic trade buyer would, and it depends, because if it's an international buyer and they want to keep the UK operation, then the management team is going to be important for them. But they're probably the key things, as you said.
Yeah, I forgot to say the forecasts. They probably need to support a finance package. So
yes, exactly.
Significant.
There'll be a bank.
You won't do staple finance probably, but your forecast will be looked at.
Yeah, there'll be a banking work stream. Some private ones will do equity underwrite a transaction, but there'll largely be a banking work stream. There might be a banking work stream if there's a trade buyer as well. They might need some banking support. Yes, and therefore forecast will probably be scrutinised more. I agree with that. Yeah,
marvellous. Thank you.
Thanks a lot, James, for that. Hopefully that's sort of covered there. As we start to sort of draw to a close, are there any questions that I've missed, or anything you'd like to pop your hand up and ask just before we start to draw it to a close? Anything else you want to add, Nick, before we close? Stuart, yeah. Go ahead.
Just a quick one. We're in a new interest rate environment. This is kind of the new normal. How's that impacting valuations?
It's a good question, and the honest answer is it's probably a little bit too early to see. But I think generally, from a private equity perspective, funding is now more expensive. A lot of private equity guys have had 10 years of basically free money. to fund these transactions on a leveraged buyout situation. And now it's costing, going back to normal levels, pre-2008 levels. So I think multiples, I think, have in the last 12 to 18 months anyway, slightly come down. We saw a bit of a bubble in the 18 months post-COVID, the summer of 2020, and how they have come down, particularly for tech businesses. As I said before, we often see, we previously saw big revenue multiples or recurring revenue multiples for tech businesses, even for businesses that were loss-making. And that's definitely scaling back. Definitely, we've seen that in the last 6 to 12 months. And I think generally, people are putting in higher funding into their leverage buyout models, and therefore it means equals lower value on day one, fundamentally. So I think we are seeing slightly lower multiples, but I think we'll see that kind of play out over the next probably 6 to 12 months, for sure, really.
Thank you.
That's great. Nick, just before I sort of bring it to a close, is there anything else you want to say at this point?
No, I mean, I appreciate that it's kind of a very quick 45 minutes whistle-stop tour to things. So if anybody does have any questions or thinks about anything later, then maybe I'll put my email address in the chat box. So feel free to drop me an email, and I'm very happy to jump on a quick call or answer a question by email as well. So I'm happy to do that.
Oh, brilliant. Thanks. So that's great. And Nick, huge thank you for this. Thanks everyone for participating, listening, your questions. It's been brilliant. I'll just say that I've had quite a few interactions with Nick and Gerald Edelman, the firm, and his co-partners over time. They are, if I'm all right to say this, Nick, they're very relationship orientated. They're very happy to build and develop interactions, cross-referring business, and build good relationships. And I've found them, I have to say, I found Nick and his colleagues fantastic to work with, and we do cross-refer a fair amount of introductions and business. So yeah, I'd get involved. Do contact Nick and make contact with him if you wish for now or future. I would definitely encourage that. But and I'll post this on LinkedIn sometime this afternoon about this meeting. So any comments would be great after the LinkedIn post. If you've got any further questions, we'll answer those. And you can download the webinar and listen to it again, or pass it on, or whatever. So I think that's about it. Have a great day. We've got something called Guild App on our website, which is a peer-to-peer network you might be interested in if you're not involved in it already, but you can see it on the FD Recruit website. So thanks again. Cheerio, everyone. Catch up soon.